Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, May 19th. It is 4:49 p.m. Eastern Time, and I'm coming to you from St. Augustine Beach, Florida with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what you need to know for next week, and update the world famous 21 over 21 leaders list. Let's dive right into it. State of the market continues to be in an uptrend led by large caps, more specifically tech related large caps, the XLC, XLK, XLY, tech heavy sectors within the S&P 500. Regional banks continue to be an issue. Commercial real estate continues to be a mess. Check the trend gauge over here. Yesterday we updated leaders to uptrend, also short term, which is the 5 major indexes versus their short-term 21-day exponential moving average, moved that to uptrend. Dow, the main laggard, played a little bit of catch up, but not enough to get back above it by the end of the week. Medium term, the 50-day moving average, where are all 5 indexes relative to that? Well, big caps remain above there. The Dow broke below but got back above by the end of the week. Mid and small cap are playing ping pong with the 50-day. Actually, mid are playing ping pong with the 50-day moving, and small. Actually, we've had a lot of changes this week and different days of strength and weakness and jockeying with these moving averages. Long term, mid caps peaked above, closed the week below. Small term still firmly below. Large cap index is still firmly above. So the bifurcation remains. But what happened today? We were down red on the week, but nothing to be concerned about. It was a healthy consolidation after 2 strong up days, Wednesday and Thursday. Here are the final numbers. RG7, our 7 ETF growth composite, down 0.55. S&P started out positive on the day, made a new recovery high for 2023, but then faded after 11 o'clock when some bad news about the debt ceiling negotiations came out. Apparently, Republicans walked out because Democrats, I don't know, it's just a mess. They'll get it done, but there's always going to be some shenanigans and posturing. NASDAQ 100 down 0.2, Dow down 0.3, mid caps down 0.9, Russell 2000 small caps down 0.6, global diversified 60/40 just down 0.01% on the day. In-house GROTECTION down 0.28%, giving back a little bit of the gains that we put up over the last 2 sessions. For the week, all 5 of the major indexes were positive. But the bond indexes dragged down diversified portfolios. Global bonds and domestic bonds down. Broad bond index is down more than 1% on the week. That brought 60/40 global to negative, and also 60/40 domestic to negative on the week. While the S&P had a good week, it was bonds being the culprit. Then we'll hit the tail of the tape and, of course, the updated 21 over 21 leaders list. Let's dive right into it. Here's the S&P 500. You can see the higher high above 4,200 today, and closing down below that. Kind of a bit of a resistance area between 4190, which is a fib, and 4199, which is another fib. 4195, the prior high. 4187 a couple of weeks ago. We undercut and reclaimed that. All in all, nothing to be concerned about on the pullback today. Very normal. We'll go to the 5-minute chart here, and you can see absolutely nothing going into 11 o'clock. Then Jay Powell took the stage. We started to sell off a little bit, but this big drop here was when the news about the debt ceiling negotiations came out, and then we just based in a tight range, 16-point range into the close. So not a lot going on. Seemed like a lazy summer afternoon, but we haven't hit Memorial Day yet. Back to the daily and back to the NASDAQ 100, the leading index. Just a little pullback after very strong move on the week. Dow Jones Industrial Average, here's where the choppiness starts to come in. So broke below the 50-day on Tuesday, got back above it on Wednesday, got above the 21 on Thursday, broke back below the 21 today, but holding the 50-day moving average into the week. Relative strength continues to be a sore spot for the Dow. Mid caps, MDY, more choppiness, as you can see. They've been living below the 50-day and the 21. Tried to get back above on Thursday. In fact, including the 200-day moving average with that, because they're so pinched tightly together. Uh, Higher high and negative reversal today, basically closing right on the 50, right on the 21, barely above the 8, and 7/10 below the 200-day moving average. Really no trend here at all on mid caps. They're still in this consolidation as they haven't gotten back above their high from the beginning of May. Let's go to small caps now. Some little bit of relative strength at times during the week, notably on Monday and on Wednesday. Wednesday, we got back above in the small caps, back above the 21 and the 50. Second close above both of them on Thursday. Third close above both of them on Friday, but a higher high and a down session on the day, still firmly below the 200-day moving average. Moving in the right direction here, at least you can see here, choppy, but keeping pace now with the S&P 500 over the last 2.5 weeks. That's a positive after this big, uh, terrible move down tied to commercial banks. Let's look at those commercial regional banks, and regional banks now actually showing some relative strength. Uh, Early this week, not so much to close the week, but you can see how they're much worse off than the IWM index is. So other sectors are picking up the slack for the weak regional banks. Let's get to the dollar, which had been strong lately. A little bit of a give back today on the dollar. Didn't quite fill the gap. Maybe it did, but just down 0.28, reasonable pullback. But the trend now in the dollar is higher, above the 21, above the 50, still below the 200. I think you know that since the dollar was weak, the inverse correlation with precious metals stayed intact. Nice up day for gold. Ran into the 50-day moving average, which is still ascending. The 21 has rolled over. Gold stocks GDX still below the 50-day moving average and the declining 21. Really a bad week for gold and gold stocks and silver also. Let's take a look at SLV finally. And update on the day with the weakness in the dollar. Let's go to Bitcoin and then we'll hit bonds. Bitcoin, tight range really on the week, but below that 16 level. Before we go to bonds, we got to go to the VIX, which ticked up a bit on the day, especially after the negotiations failed. Still below the declining 21, back inside this recent trading range that we've had over the last 2 weeks. Broad bond index BND down across the board. 5 days, 5 straight days, the broad bond index weaker. Really a bad week for bond prices, which means yields were up all 5 days. Uh, from an index perspective, there's BND down, TLT, the long bond, down also 5 straight days. Zero TYX, this is the 30-year yield all 5 days. In fact, make it 6 days if you go back to last Friday. TNX, the 10-year, 6 straight sessions higher too, breaking out of their recent range. Stocks seem to be okay with the rising rates. However, as they did put in, as I said, a positive week across the board on all 5 of the major indexes. Sectors, they're a different story, still bifurcation there. So let's get to the tail of the tape now. And you can pause this. Positive stochastics, on the major indexes, the RG7 and the NASI. Dollar is not good. TNX range breakout now. That's also generally considered a negative. Still on the bull case as we broke the S&P broke the 21 for one day, got right back above it. News, as I said, no progress on the debt ceiling. And Powell, during his speech, Bernanke it was a Q&A really. Uh, he said that the bank stress actually may keep them from having to raise rates more than they ordinarily would have. So that was a little bit dovish on rates. But again, the same time that they were speaking, and there were no major new no there was no major news to come out of this, but it certainly wasn't hawkish. But at the same time as the debt ceiling news was trickling out, and that didn't help things either. So the day count from up to with a consolidation day, third day above the 8 and the 21. Expectations remain positive. Tight base 4+ hours into the close. That was, like I said, kind of like a snooze fest. Sectors on the day: yields higher, gold and silver stocks higher, healthcare higher. Not much else, even though it was pretty much a mild day. Dollar lower. The big thing was that XRT got hammered today. Before the open, Foot Locker came out and missed and lowered, and that trickled throughout apparel and footwear across the board. uh, Hit pretty hard. Really, and XRT, the broad index, down 3.6% on the day, and really looking pretty horrible. Let's take a look at this really quick. This was not what retail wanted. In fact, you can see the two recovery days on this was Home Depot, I believe, when we were down. Then Target and Walmart reported, and we rebounded. But today, Foot Locker, and I guess because of how between the apparel and shoes, athletic shoes primarily, but this hit all kind of apparel and footwear sectors across the board today. And frankly, as I said, the entire retail sector making a lower low on the week, lower closing low on the week, down 2.1%. You can see the relative weakness in broad retail here. It's been going down for a significant period of time, months actually. Retail on a relative strength basis peaked in February, when the market peaked since then, and it's just been a mess going lower. Even when it was going, trying to rally on a relative basis, it was weak. So not good for retail. And I guess there have been some pockets of luxury sectors in retail that have been okay, but they got hit too over the last week. In fact, we got stopped on Lulu. You saw what happened to ON. Elf is hanging on. That's not considered luxury retail, but it's got broad appeal. But and we'll take a look at those stocks when we go through the 21, including the cut list. But retail continues to lag, and I guess the recession fears are feeding into that. So what did we do on the day? Just sell our Lulu, closing the week. The last piece we sold for flat, less than a percent gain, dropping our exposure from 1.35 to 1.32 on an adjusted beta basis. Bottom line for today: healthy consolidation day after two strong up days. Let's see what next week brings. And now let's take a look at some charts. We're going to go into, first of all, the four that got dropped from the 21/21 list, and we're going to start with one that we owned coming into the week and had some high expectations for. Those expectations blown out of the water on the negative reaction, and then as if we didn't need this, three continued follow-up lower low days. That shows that your first sell is your best sell um, when bad news comes to the growth arena. Second removal for solar. This actually held the 21, but look how ridiculously bad the performance was this week. Went from 232 all the way down to 203, bouncing at 200. That's not leadership. look at the relative weakness. I don't want any part of this, and there's m- at least three solar stocks that are acting better. One of them got added, and you'll see in a minute. So we punted First Solar. Lulu closing below the 21. We've been selling pieces of this all week. Looked like it was going to reclaim the 21 yesterday, but this was caught in the retail downdraft today, closing below the 21. And we're done with Lulu after being our biggest position less than 2 weeks ago and acting great since earnings, trending higher along the ADMA. Started to see some weakness, and you can see the relative strength line tells the story here. Uh, as long as something is trending above the 8 and the relative strength line is going higher, you are in Shangri-La if you're a growth stock holder. But as soon as that weakness comes, pay attention to it. And we're just, the last sell out at break even, which we bought back here. Um, so basically a whole lot of nothing for Lulu over the last, let's see, we bought that in March, so almost a 2-month holding period. And finally, XLF getting back above the 21-day EMA is a sell and a boot for FAS, which is Inverse Financials, which you can see close below the 21 on the week. So those were the four that got booted out. Let's see what four were added, and let's see what the holdovers are. So we had a lot of strong reactions to earnings this week, and then some follow-up um, strength also. I'm going to take the stochastics off here so that these look a little bit better, and we'll start off with the four that were added. Palantir, a couple weeks ago, big move up on earnings, went to the top of the base, normal lower volume pullback, got some upgrades, and relative strength kicked in. And it had two very strong days back to back. In fact, yesterday up 14.5%. Gave back and followed through early, but then when the market reversed, ended up barely down on the day. But this looks like it has some power to it, and so we added it to the 21/21 list. Live Nation, Michael dug into the financials on this one and was really impressed with the fundamentals. He owns it personally. We added it to the 21/21 list. We'll be looking for an opportunity to add it to our client portfolios. Dynatrace, another one, solid fundamentals, nice move up on earnings, some upgrades out of its base, very tight inside day on lighter volume. Look at the volume on this. Leading into earnings, we actually own this on the last earnings gap up, but then what happened? The market started to correct during February. Dynatrace couldn't weather that storm. A lot of people sold out, and then it put in a bottom down around the 200-day moving average, where all the time you see managers come in. It's considered a value area for a strong stock. Stock with strong fundamentals. They came in, started buying it. The relative strength started getting better, and then the 2 weeks leading up into earnings, we had this final shakeout here. It um, rightened rightened itself, put in a bottom, and then one more shakeout and a positive reversal to the upside on 5-3, and then just really nothing but buying since then, including, you can see, volume buying coming into it. So that's the second stock, the third stock added. The fourth one is one of those solar stocks that's acting well, and you're going to say, yeah, but look how much it gave back. Well, first of all, up big volume, 392%, and was up 30% on earnings. Follow that up with its earnings move on its last earnings report, which was 44% on 1,488% volume. Then it took a break, normal break, not breaking the 21. And then all solars got hit over the last few weeks. There were some tariff issues and just general weakness in the solar stocks, but they reported earnings, more power, second day higher high, then reversed. But this looks like people got a little heads up that there was a secondary offering coming on the 15th when it was down 10%, more follow up on the 16th, announced after hours. Then it finally priced at 28, I believe. The 50-day moving average held that and held the 28 area. And then today, some volume coming back in, 133%, up 8%. This looks like it might be a hard to handle stock, but Definitely one that some growth managers are buying, which you can tell by its last earnings report, this earnings report. Some people looking to get out of the way after the secondary offering. You see the big volume spike on the offering. And then it put in a bottom at the 50-day moving average and bounced off of it with authority reclaiming the 21 also. Definitely has our attention, and there are a couple other solar stocks that are acting well also. Now, the holdovers. ELF, which we own, there's a red flag here if we own it. ELF holding the 21 tight. We're probably going to have to cut this unless we start making some progress. They do have earnings next week. CMG acting just the way you want all stocks to be after you buy them. Relative strength continues to trickle higher along with price. 5 up days this week. Couldn't ask for much more than that. AMD, inside day today after a strong day in the strongest sector. Serious relative strength. AMD, we own this. It looks great. SMCI, fantastic week. Gapped up today, then went negative, reclaimed some of that to just basically be barely down for the week. Connor owns this on his personal portfolio, and can't wait for those guys to get here to St. Augustine at the beginning of June for 6 months, and we're going to do a lot of hands-on work. And note the volume also, why it's climbing higher after this nice tight 2-week consolidation after its earnings gap up. This is best case for something that has a good earnings reaction. A couple of upgrades in there too. Shopify not really going anywhere since the 2 days of follow up after its earnings report, pulling back to the ADMA. Celsius making a little bit of progress. Strength early yesterday, not so much today on a market pullback day. Uber, our second biggest position behind Chipotle, nice bounce off the ADMA on an upgrade yesterday, and they've got a new offering. They will, with parental authority, chauffeur your kids to and from school. So probably, I imagine there's a market for that. Intuitive Surgical continues to make higher highs, riding the ADMA higher. Microsoft, it's AI. I mean, it's one of the leaders in AI, I'd say, among the big 4 or 5 or 6 names, and it just continues to ride that wave higher. DraftKings finally bouncing at the 21 after seemingly selling off forever after its earnings gap. Some buyers finally showed up. Do note the volume the last 2 days versus the last 5 days of volume when it pulled back all the way to the 21 EMA. ITB Home Builders continue to act well. Race Ferrari continues to act well. Gap up today on a weekday in the market, approaching that 3 times Livermore area. Mondelez, a little bit of a pullback after strength, not really going anywhere. Keep this on here as a representative of the staples to see what it's doing. Wingstop, finally going sideways. Looks like it might need to consolidate, but holding the 21 the way you want it to after some big violent move up and then shake out after its earnings report. Lantheus, relative weakness this week, but hasn't even touched the 21. This 100 Livermore area, a very reasonable spot for it to pull back, and that's what you saw. NVIDIA, one of the market champs right now. Great week. We trimmed a little bit of this yesterday. As it got 4 ATR extended from the 21 EMA. They've got earnings next week. We will be looking to increase that position once all of that smoke clears. And finally, Meta, we own this also, doing what you want it to do, right? The ADMA higher after an earnings gap up, and that's the 21 over 21 list, and that's going to wrap it for the week. Reminder why we do what we do here at Revere. It's to keep our clients out of the way of severe bear markets that can destroy their nest egg. If you're interested in this approach, reach out to me, Don at revereasset.com, or my partner, Dan Stewart, Dan at revereasset.com, or you can phone 855 Real Wealth. That's 855-732-5932. And with that, I'm going to remind you, it's not how much you make in the markets, it's how much of that you can keep. That's why we espouse active management. You don't want to sit there sucking your thumb while the market takes your money like it did last year, like it did during COVID, like it did during the tech bubble bursting, and like it did during the financial crisis. There's common sense things you can do to get out of the way, as common sense is taking an umbrella when it's going to rain, or going to the have your car looked at when the service engine light comes on. Reach out to us if you're interested in this. And that's the reminder that it's not how much you make, it's how much you keep. And with that, I will lock up and finish up the week ending Friday, May 15th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Nothing but the truth, nothing but the facts here from Revere. Thanks for listening. Have a great day.